So moving on to infrastructure. So infrastructure is all those things that make a modern society work. So roads, airports, railways, power stations, pipelines, electricity distribution networks, sometimes even data centers, cell phone towers. All of those things can get lumped in here. There are two key things to be aware of when you're choosing an infrastructure fund. The first is, what are they counting as infrastructure? The core infrastructure, which is what we like to focus on, is your telecommunications, transportation, and energy primarily. When you start moving beyond core, people start including contractors who service these things, engineering consultants, sometimes even maintenance and manufacturing people. So moving beyond the core, you're starting to get more into an equity-like play. So be careful what you're actually investing in. So we like core infrastructure, and there are three main global infrastructure index ETFs available in Australia. There's GLIN, which is the BlackRock one that tracks the FTSE Developed Core Infrastructure 50/50, and it's hedged into Australian dollars. That's an important point, which I'll come back to in a moment. The IFRA, the VANEC product, tracks the same index and is similarly hedged. It's slightly more expensive. Now, the significance of the 50/50 is that it puts caps on individual sectors rather than it being a more global allocation. The third one is the Vanguard Global Infrastructure, or VBLD. It's a little bit more expensive, but it's unhedged, which is important, and it doesn't have the 50/50 tweak to the index. So that's our preferred one, primarily for those two reasons, that it's core and it's not hedged. Part of the reason why you buy global equities is to get diversification. You want diversification by market, you want diversification by currency, you want diversification by regulation, and you want to develop the diversity by market sectors. The Australian market is obviously, it's Australian, it's dominated by miners and financials, whereas the US market has got a much more tech and industrial focus. So that's part of why you go to this. So why would you give away your currency diversification and generally pay more money for it? The other advantage of having unhedged overseas equities is that it reduces your risk a little. Now, that might sound paradoxical, but generally what happens is when global markets fall, that's a sign to most investors to search for security, and they do that by buying the US dollar. They do that by selling commodities. And so both of those actions have the effect of depressing the value of the Australian dollar. So when the Australian dollar falls, the value of a US dollar asset rises. So that slightly dampens the movement. So overseas market falls, Australian dollar falls, closing out some of that gap. So that's why we like unhedged equities. We hedge bonds for a completely different reason, but that's a story for another night. And then there's a couple of active funds on the market. You do need to be a little bit careful about saying Vanguard's so much more expensive. Yes, it is nearly 30 basis points, 0.3% more expensive than the iShares, but some of that comes from the gain on the currency. These are very hard to directly comparison. So historically, because Australian interest rates have been above US interest rates, that the forward sale of that currency gives you a bit of a pickup in yield, which is really important in the bond market. So those I see should be taken in that light. But yeah, you would expect infrastructure to be more expensive to manage than large cap global equities. And for here, the Vanguard product is our pick.